This is the Asia Trade. I'm Shery in Seoul.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set to extend a fresh sell-off as US stocks, bonds and the dollar tumble. Renewed fears over President Trump's trade war overshadowing cooling in US inflation ahead of the tariff impact. The White House says tariffs on China are now at 145%. The president acknowledging what he calls transition problems, but expressing confidence in his path. And US-listed Chinese stocks slide on reports the Trump team is considering delistings as a trade war tactic.
It was another violent reversal on Wall Street. We're talking about riskier assets selling off, U.S. stocks sinking, the 30-year yield spiking again, the dollar also losing ground. And all to do really with that reversal when it comes to the volatility in the markets, right? I mean, we have seen the VIX at one point top 60 as well. And this after the biggest buying on Wall Street since 2008. So we're now seeing treasuries, especially when it comes to the long end, actually reverse some of those losses, and yields actually advancing in the overnight session. We had some news around inflation data. We're talking about cooling inflation for the month in March, which was really unexpected. But of course, the price data coming before these new tariffs, so they will have implications and could really accelerate prices in the long run, Heidi.
Shery, take a look at what a change in just a few hours makes when it comes to the outlook for the last day of trading that we get here in Japan and across the rest of Asia. Of course, we had that swift rebound in the Thursday session for the likes of Japan and South Korea. But to take a look at the downside that we're now seeing across the region, Chicago Nikkei futures looking softer. We're also seeing significant downside when it comes to the start of trading in Sydney, where we did also hear that pushback from the RBA Governor Michelle Bullock urging patience when it comes to these building expectations of rate cuts, not just for the RBA, but for central banks more broadly, right? This idea that the Trump trade war is really going to exacerbate the challenge for global central banks in their easing trajectory, that has been seeing some pushback from the RBA, and we have seen some of the pullback on expectations of 50 basis points back to 25 basis points, but that is just really all over the place when it comes to market pricing at the moment. In terms of central banks, we're also getting the decision from the Peru Central Bank leaving the reference rate at 4.75% They're holding for a third straight meeting. They're keeping the door open for future cuts is really expected. Inflation falling in March. We had lower energy prices, but of course the global tariff situation continues to wreak havoc across Latin America, across the EM complex. If you take a look at emerging markets, that's the MSCI EM currency picture there. We're looking a little bit sort of stronger by 0.6%, but we do expect that to really oscillate depending on the direction of the dollar, and of course we have seen really the dollar slumping along with other US assets in the overnight session. This is President Trump again expressing confidence in his tariff plan while also admitting that it may face what he calls transition problems. This came after the White House clarified that the US tariffs on China have risen to 145%. Trump also saying again that he's looking to make a deal with Beijing.
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond nobody. How people stood for it, sitting in my position, is not even believable.
Well, let's bring our M-Live strategist, Mark Cranfield, our global economy correspondent, Enda Curran, and our China correspondent, Min Lo. And Mark, let me start off with you when it comes to just the volatility that we continue to see play out in these markets, right? The relief rally, if you want to call it that, you know, after Trump said it was a great time to buy, that was pretty short-lived because the fundamentals, the uncertainty and the sort of devastating consequences of this trade war situation remain unchanged, even with a 90-day pause.
Yeah, indeed. The only confidence that global investors have is that they've got no confidence in making long-term investment decisions at the moment. By pushing the tariffs out for 90 days, in a way, it's just confused the situation even more. And yet, some people are having to make decisions on a day-to-day basis already to manage their portfolios. So it's a very difficult time for investors, and there are one or two very scary signals being sent out from financial markets, not just the quick reversals that we've seen in US markets overnight. But if you look at, for example, what's happening with you've got the euro back at 112, that's very significant. great strength in that currency with the yen and the Swiss franc as well. And at the same time, you've got the long end of the US Treasury curve, yields going higher. The US dollar is not getting support from higher yields. That has very big consequences across risk assets, and traders are now readjusting their views based on the fact that the US dollar can fall while yields are rising. That is something we haven't seen for a very long time, and it has very big implications for what happens to Asian currencies, to European currencies across the space, not to mention yield curves as well. And what we've seen in the past is if the German yield curve steepens, it's often very, very good for the euro. So this could have further to run as well. And the euro being the second biggest currency in the world, in most currency baskets, it's number 2 for people. And even the Chinese yuan is forced up the league tables as well, because that feeds off of the euro together. So when you see a currency as big as that moving, everybody has to pay attention. And it looks as though it's going to gain some traction in the coming weeks. So yes, there may be some good news in the fact that tariffs have been delayed, but the confusion element among people in the investing world is very, very high. And when they're confused, they don't start making long-term decisions, they just react with their gut. And that's why you get highly volatile markets.
And really not good news when it comes to China. The White House clarifying that the tariffs could be around 145%. Is there more of an understanding now and sort of urgency to deal with the economy in the U.S., with even President Trump acknowledging potential transition problems?
I think the euphoria of yesterday really waned off today when people realised the gravity of the tariffs that are on China. That's America's second or third biggest trading partner, depending how you split the data. The White House coming out confirming that the final number wasn't 125 odd percent, it was actually 145. We have companies now saying that they're putting shipments out of China to the US on hold. I spoke to one yesterday who made this very same point. So there are concerns over the impact on trade between both. By extension, then, of course, the shipments that do arrive will be a lot more expensive. So economists are, even though they're maybe watering down their recession forecast, they're warning that there will certainly be a hit to growth and inflation, despite today's good inflation data, of course, preceding all of that. And then, of course, in terms of the policy signals, President Trump, as you mentioned, making the point, there will be a cost, there will be transition problems associated with all of this, but he showed no signs of climbing down. He said at that cabinet meeting he thinks a deal could be reached with China, but he didn't signal that they're going to talk near term. He didn't give a list of asks for China either in terms of specifying what the US wants out of it. So, you know, right now we're at an extraordinary moment whereby the US tariffs on Chinese goods and vice versa are soaring, but we still don't see that off-ramp for the real negotiations to begin.
And Mimi, in the meantime, we're starting to see some examples of what could potentially be used as non-trade, non-tariff weapons in this next stage of a trade war, right? We saw Beijing reacting with that modest reduction of US film titles allowed approval in China, which is obviously a pretty big market. But then also we're hearing that potentially, you know, listings of Chinese companies in the US could also be on the table.
Yes, it's interesting that so far China actually hasn't increased its tariffs on U.S. goods. A few ways to read it. It's possible China will announce more countermeasures later on down the road, or it's possible maybe China feels that the levels are prohibitive enough that further tariffs are just not going to make much more meaningful sense. And so you see that frontier of the economic war moving to other parts of the economy, including the services sector, the financial sector. It's interesting China is choosing to limit the number of U.S. films that it would import, because this is something that is very high profile, but with almost zero downside for China. Many of these U.S. films that screen in China can get about a fifth of their revenue from China. But there are some analysts, though, who are saying, given the imperative for China to expand domestic consumption, China may still approve some of these big potential blockbusters and stop the import of the smaller films, because that would still at least whet the appetite for Chinese consumers to spend, given that the box office is, after all, an important anchor for the retail market. But we know when it comes to the financial markets, for example, China has timed some of its retaliatory measures just ahead of U.S. futures trading. And as you said now, potential delisting of Chinese companies in U.S. stock exchanges is another risk for companies on both sides of the Pacific as well. And of course, other traditional additional measures, tightening the noose on rare earths, and perhaps even stopping cooperation on fentanyl could be on the table as well.
Mark, are we going to see China potentially weaponizing the yuan, its treasury holdings as well? I mean, and I guess, is the pressure on the Chinese assets, at least in the short term as well, inevitable at this point?
Certainly, people in the markets have seen how the PBOC have used the daily fixing very cleverly, just ratcheting up day by day. They're sending a clear signal that if they need to, they can push the yuan into whatever level is necessary for them to be compensated against the tariffs which are coming in. Today, it will probably be lower. That's simply a function of where the euro is so strong that feeds into the yuan basket, so they can bring it down a little bit there. But if you look at the domestic markets, it's pretty clear that they've been supporting their own equities very strongly. The PBOC has given a larger amount of money to the funds which go directly into Chinese ETFs. That's also benefited the market as well. How long they can keep that up is another question, but they seem pretty determined. And of course, people expect that the Chinese authorities will get together and provide a very large stimulus to the economy, probably even lower interest rates in China as well. There's a lot from the Chinese side they can do to try and improve conditions for investors in China and for the economy itself. Whether they can do that with the headwinds coming from offshore, from the disruptive global markets, investors will have to pick and choose. But clearly, it looks as though there's a decent chance that Chinese assets in China could outperform what's happening in the United States. And people seem to be skewing their preferences for investment along that direction.
Buck, I wanted to quickly get to the flip side of the yuan question, which is, of course, what we're seeing with the US dollar, right? Take a look at this chart, which shows really just how bearish the markets and traders are on the greenback at the moment. The most bearish on the USD in 5 years per BBDXY risk reversal. So that historic volatility really also gripping the dollar on top of other US assets. Is this just set to continue, though? Is further dollar weakness kind of inevitable? Because this is clearly a situation where a global instability is not going to see the greenback playing any sort of haven role.
For the time being, investors, traders are pretty clear that they expect the Federal Reserve in the United States to lower interest rates, and several times in this cycle, maybe even as much as another 4 times this year. Those things ebb and flow, but for now, it's pretty clear people expect the Fed to come to the rescue in the sense that they will be forced to lower rates because the US economy is going to slow down, and they'll be able to look through the inflation situation, and probably they will be thinking that US employment will deteriorate. That's what traders are expecting for now. If the Federal Reserve comes into the picture from that point of view, regardless of whether other interest rates around the rest of the world are fall, even if the European Central Bank, the Bank of England, even if they lower interest rates, the fact that the Federal Reserve could go into another cycle of cutting rates is the biggest factor for the US dollar. That's how people are viewing it for the time being, and they probably will continue to do so for at least the next 90 days.
And this is such a tricky situation, right? Because we heard from Kevin Hassett that the negotiations are well advanced with its trading partners at this point. But at the same time, if these drag, which is the expectation right now from the markets, how big of a risk is it for the U.S. economy at this point?
I think given, as Mark mentioned, the reaction among the dollar and treasuries, the pricing there does suggest that there's certainly a need for an injection of confidence into this process. Investors need to be brought on side that this is going to achieve the outcome that the administration says it wants to achieve, which is, of course, stronger growth, more investment and manufacturing in the US. Now, President Trump and his officials, like you say, they say they're quite close to at least some deals. They've made a point that over 50 governments have reached out to them to get on with the process of working out whatever it is they're going to do. Commerce Secretary Lutnick made the point that there are offers on the table that wouldn't have been made without these tariffs. Now, that's the kind of rhetoric around this. We'll have to see the specifics of what kind of trade deals do eventually come through. How meaningful are they? Will investors in the broader community see them as genuine, real trade deals that will put this threat of tariffs behind them and they can move forward from here, or will it be seen as a kind of a sticking plaster kind of effort that ultimately will lead to another round of tariff threats at some point in the future? Now, that's on the rest of the world. That doesn't include China, of course, which is obviously now going to be the huge part of this jigsaw. Because remember, the starting point now is with tariffs on China, 145%. If that's your starting point, one has to wonder, where will those tariffs settle in any kind of a negotiated trade deal that might come out of this? What will the specific asks be by the US to get to that point? What will Beijing look for on their side? What will they be willing to concede? So, yes, clearly the administration has tried to take the sting out of the tariff story this week by that move on the so-called reciprocal tariffs. But, really and truly, the tariff burden on the economy is as high as it was when these tariffs were first announced a week ago. There are a lot of question marks about what it means for the economy, and clearly this process has a long way to go.
That's fine.
Bloomberg's Enda Curran, Mark Cranfield, as well as Min Lo there with a wrap-up of all of the implications of these President Trump tariffs. And we continue to follow a helicopter crash as well in New York. It crashed into the Hudson River, killing all 6 people on board. City officials say the passengers, including 3 children, were from Spain. The helicopter's flight path shows it had flown around the Statue of Liberty and George Washington Bridge before the crash. Is the latest in a series of recent incidents, rattling confidence in U.S. aviation safety.
Coming up on the Asia trade, we asked the Eurasia Group what it would take to instigate US-China trade talks. Shinhan Asset Management telling us why they now prefer international equities over US stocks. Plus, we'll be speaking with AmCham Korea about how South Korea is navigating these Trump tariffs. Much more ahead. This is Bloomberg. Well, Bridgewater Associates founder Dalio says President Trump's tariff and trade policies could have been handled better and have dramatically affected attitudes about America's reliability. Dalio spoke with Bloomberg about a likely U.S. recession and what needs to be done to fix Washington's relationship with Beijing.
There has to be a recognition that we have a structural problem in that we have an interdependency that the United States can't, either financially or geopolitically because of the risks, be in a position where it's dependent on getting stuff from China. And similarly, for the Chinese, they can't feel safe about getting their capital returns in that way. So in a global economy, you can't have, by definition, large imbalances. So now the question is how to deal with that. That's an engineering exercise. In my opinion, they can have a negotiated way in which the currency is raised. They have to, in one way or another, deal with this, reduce that. So the currency can be raised, the RMB, which would happen by then starting to sell off reserves. The United States likes the fact that the currency would appreciate and that probably the Chinese like the fact that they can get less in debt by selling off some of their holdings in that dynamic to support the currency, in which case then China has to not just be a manufacturer, but it has to be a consumer. And right now, about 33% of all manufacturing in the world, which is more than the United States, Germany, and Japan combined, is from China. So they manufacture. The United States does not manufacture that. And so what the world needs now is the Chinese to be consumers. So if you were to have that foreign exchange increase and you were to deal with trade together in a sensible way, I think, ideally, then you would also have, naturally, Chinese doing an increase in monetary and fiscal policies to raise demand, particularly consumption, because exports are going to go down. Manufacturing is going to be a problem, so that if they raise consumption and the United States becomes less consumption driven and more production driven, at least those are movements in the right direction. Such negotiations, unfortunately, and such actual big changes are unlikely to take place quickly enough and well enough, is my fear.
Mm-hmm. But, Ray, I mean, given that and given this possible permanent scarring of U.S. dollar and treasuries, is a U.S. recession actually avoidable?
I think it's likely that we're going to be in a recession. And the question really, recession is, a line at zero you get, and then, sort of 2 quarters in that. And I think right now it's close call and it's probable. But who cares about, let's say 2 quarters of stagnation or a little bit of negative? I'm more worried about the greater dynamic of these conflicts. I'm worried about more serious issues.
Bridgewater Associates founder Ray Dalio speaking with our colleague Francine Lacroix. We have more ahead on the Asia Trade. This is Bloomberg.
Let's get you the latest from the corporate front. Bloomberg's been told that Volkswagen fears President Trump's tariffs will make its Audi Q5 model practically unsellable in the US. The Mexican-built SUV, currently priced at around $45,000, has been Audi's bestseller in the US. Sources say the carmaker now expects the model to be hit with 3 separate levies, totaling around 52%. Swiss pharmaceutical giant Novartis says it plans to invest $23 billion in the US over the next 5 years to ensure that all its key drugs for Americans are made there. The investment will fund 7 new US facilities, including a research outpost in California and expanding 3 existing ones. The plans were revealed as President Trump promises to impose tariffs on global drug makers. Chinese bubble tea chain Haidi is moving ahead with a US IPO despite the turmoil in markets. The company is seeking to raise over $400 million by offering ADRs at up to $28 each. The company cites geopolitical tensions and tariffs as risk factors in its filing, signaling that all of its products are made in China and shipped overseas. Shery.
Heidi, take a look at how U.S. futures are trading at the moment. Early in the session, we're seeing downside of about 0.25%. This coming after another violent session on Wall Street. We had every index falling after, of course, the biggest wave of buying since 2008 already. In fact, the swings in the American equity markets have made it the most turbulent and the more turbulent than Bitcoin trading itself. This is Bloomberg.
I'm not the politician, I'm not the negotiator, I'm not the person to say whether that style of handling it was better or worse. I would say that it dramatically affected psychology and attitude about the United States' reliability.
Bridgewater Associates founder Ray Dalio telling Bloomberg that he thinks President Trump's approach to tariffs has hurt the United States' reputation of being a reliable trade partner. Joining us now is Maziar Minovi, who's the CEO at political risk consultancy Eurasia Group. Really great to have you with us. And I've got to ask, as we've been asking all of our analysts and guests, do you think it's plausible at this point that Washington and Beijing can get to the table for any kind of, meaningful negotiation? Is there an off-ramp that you can see here?
Well, those are 2 different questions. We definitely think, given that President Trump is keen on building drama, keen on negotiations, and keen on the art of the deal, we certainly see within the next few months room for both sides to get closer to the negotiating table, maybe even up to a summit with President Xi, which right now seems implausible. But all of that is very much within his playbook. The second question, the more important one, is will there be a deal that is going to meaningfully ratchet down the tensions and allow for trade between the two countries to continue? The answer there is a very clear no.
We're now hearing of a number of non-trade options when it comes to what could be used next, from Hollywood film approvals to US delistings of Chinese companies. And then, of course, there's the issue of the yuan and Chinese holding of treasuries, I guess the nuclear option. What do you think are the ones that we need to watch out for going forth? And I suppose what's the pain threshold for Beijing here?
Well, it's certainly true that the pain threshold for Beijing is much higher than for a democracy like the U.S. However, we think the road from here to there is bumpy. Some of the measures you mentioned are very much the ones we expect to be next on the agenda, principally starting with ratcheting up even further tariffs on a broader swath of merchandise goods of the U.S., but also going further, using the variety of tools at the disposal of the French, of the Chinese government, to go after U.S. companies operating in China. The services sector, where the U.S. obviously has a surplus against China and globally, is a second and third level option for most countries contemplating how they would respond. We'd expect to see that both in China and in Europe over the next few months, resorting to limiting U.S. services, be they financial, consulting, etc., as a next step.
What is Beijing's top priority right now as it fights the United States in this trade war? Because the reason that I ask is, will it be willing to use some of those weapons that you talked about, including, say, the devaluation of the yuan and selling treasuries, if, for example, their top priority is just maintaining financial stability?
Yeah, I mean, from the point of view of the Chinese, and if you've been speaking with government officials and think tanks that help them develop policy, they've understood that this is coming. The speed and depth of it is a surprise to them, as to most. But they are steeling themselves for a long and protracted war, trade war. Some of the measures you just talked about, though, are very self-defeating from a Chinese point of view. Selling treasuries in any meaningful quantity is going to lead to a significant destabilization in international capital markets, and more than the U.S., the target that could be hit by that sort of instability are emerging markets like China. So we don't see that at all in the menu of options in a meaningful way. Weakening the currency is a double-edged sword for the Chinese. As they experienced in 2015 and 16, it is very difficult to walk that thin line of being able to weaken the currency as much as you want without seeing capital outflows pour out immensely. And obviously China has massive capital limits and capital controls, but even despite those in 2015-16, they lost $1.5 trillion and really nearly destabilized the economy. So I think they'd be very cautious, perhaps a continuation of the sort of signals we've seen, incrementally coming higher in their fixes, fidgeting around with the width of the band, etc. Those smaller moves to send signals to Washington, yes, but a meaningful depreciation that they engineer,
right.
I don't think so, because in it, yeah.
No, I was going to say, because we have been really focused on these economic financial measures, but I do wonder, how close are we to potentially seeing actual physical clashes between these two superpowers. I was really surprised to see this Wall Street Journal report that Chinese officials had now sort of in a secret meeting actually acknowledged the fact that they were behind these massive cyber attacks against U.S. infrastructure. At what point do these economic, financial issues actually become physical?
There I can give you some optimism. I have to say, in my meetings in Asia this week, by the end of them, as I repeat, Eurasia's view since September that the trade war between U.S. and China was going to heat up to levels people were not expecting and faster than people were expecting. Just as people are ready to jump out the window, we discussed this topic. And here we're more sanguine, be it over Taiwan or any other military confrontation. We think the risks there are very contained in the next year or two. Of course, there's always the risk of an accident, especially now that military-to-military contacts have been cut off again. But again, if conflict gets to that level, the biggest and most immediate victim will be China's much more fragile economy. So yes, infrastructure-type cyber attacks, that is now a part of this continuous war, not war, hybrid confrontation that we see, not just between U.S. and China, but between U.S. and Russia and Europe. But that's short of the sort of risks that you're just talking about. No, we don't see that as a huge tail risk. But of course, there's so much more to worry about, including the implications of these measures that we expect to lead to both recession in the U.S. and a significant drop in activity in China within the next 12 months.
To win a war, you need good allies too, right? And it's happening at a time we're seeing that retreat of the US more broadly. Do you expect that to be more of a focus, or the focus on the domestic consumption, domestic economy side to be more important? Because we have already seen China reach out to global business leaders and also trading allies. Just yesterday, we had an op-ed from the Chinese ambassador in Australia saying that the two countries should be working, hand in hand through this.
Yes, we expect op-eds to flow freely in the months and years ahead. But let's look at the depths of the problem. The Chinese economy is dependent through direct and indirect means to the tune of 2.5% of GDP value add on the final demand of the U.S. consumer. At tariff rates, forget about these levels, at anything over 60%, effectively, U.S. is saying, don't trade with me. And we do expect at the end of even any negotiation, tariffs to remain at or above those levels. So that 2.5% needs to be replaced. And in the Chinese search for allies, the problem is their first and second and third targets will be the Europeans, other Asian neighbors, and emerging markets in the global south. And guess what? The domestic political context in all those places does not allow the Chinese to be able to shift this massive surplus onto those countries. So what we actually expect, despite the op-eds and despite the warm discussions and the summit meetings, an increase in tariff and non-tariff barriers against Chinese exports to all the regions that would be the typical allies that you're implying will be with them in the months and years ahead. This is not speculation. This is the pattern of every single global trade war. Once it starts, as we saw in the first Trump administration, the number of tariff and non-tariff barriers globally rise as other countries try to make sure they don't become the target of a redirection of exports. So we don't expect that to be a major feature of this confrontation.
So with the changes that we're seeing with the new tariff environment, what do you foresee to be President Trump's ultimate intention here? Are we going to see a renewed world economic order, and what could that actually even look like in the next few years?
That is the biggest question. And there, I think that's where, going into the election, the inauguration, many corporates and investors had it wrong. With this hope that with the inclusion of people like Secretary Bessent, this administration will maintain some moderation in its ambitions for the global international architecture. that was always a pipe dream. The ultimate goal of the Trump administration, based on the campaign that they ran, based on the desires of their electorate, is to build high walls around the U.S. economic area. And this will have multiple aims, one of which, the topic of our discussion, to keep out the Chinese, who they deem have been trading unfairly and taking advantage of Americans' generosity in by allowing the membership in the WTO, etc. That's one big aim, and that's why we're seeing tariffs at this level. But there are other aims for these walls, and the height and targeting of these walls depend on different factors. For instance, sectoral tariffs on parts of the economy that the administration deems essential to be commanding heights of a U.S. new economic order. Interestingly, sectors that are purely dominated by manufacturing, like autos and steel and aluminum, etc., these need to be coming back to the U.S. So those walls are also going to be going up. So the question for all countries not named China is, which side of the wall do you want to be on? And depending on your decision, if you decide to be on the U.S. side, you're going to have to not only accept a minimum level of tariffs that are higher than you've had before, for instance, 10% in an eventual deal with Europe on these reciprocal tariffs. You're going to have to accept the sectoral tariffs to be there. And most importantly, you're going to have to agree to raise your walls against the Chinese, especially the tech sector in China and any other manufacturing industry that can be rerouted through your country into U.S. So that's the deal. It's much easier for Mexico and Mexico's of the world to make, given their reliance on the U.S., a much harder decision for countries in ASEAN like Vietnam, Malaysia, and elsewhere.
Maziar, really great to have you with us. And for those insights, Maziar Minovi, who's the CEO at Eurasia Group, joining us. And of course, we've seen that uncertainty and volatility playing out across commodities trading, be it you're talking about energy commodities or, of course, soft commodities. We're watching the pairing of those gains when it comes to soybeans and corn as well with this escalation of a trade war. And we saw actually China making a major purchase of Brazilian soy as this worsens. But taking a look at some of the other assets we're watching, really oil holding into its biggest drop this week as investors continue to be concerned about these abrupt shifts of U.S. trade policy, the effects of Chinese demand, of course, the world's biggest crude importer. We're seeing a little bit of upside when it comes to copper, but pairing some of those gains, and gold hitting a record as that recession anxiety hits, and we've got traders again seeking havens. More ahead on the Asia trade. This is Bloomberg.
Japanese Prime Minister Shigeru Ishiba says Trump's tariffs could hit all industries as the government launches a task force on reciprocal tariffs. We're counting down to the start of trading in Tokyo and Seoul, and take a look at futures trading at the moment. Nikkei futures down almost 4%. Together with the topics, of course, we had seen a massive rally in the previous session, with the Nikkei seeing its best day since August. The Japanese yen, though, right now strengthening towards that 143 level, surpassing that 144 versus the U.S. dollar. As we're also watching the Kospi, remember, Korean stocks had their best day in more than 5 years. For more, let's bring in Asia Equities Managing Editor Lianting Tu. Lianting, as I just mentioned, I mean, we had a very strong rally for Asian stocks in the previous session, but overnight, of course, Wall Street sold off. What will you be watching today?
Yeah, of course, today's open is not going to be pretty for Asia's, some of Asia's big exporting economies, which would include Japan and Korea. But I think after all that, people are still looking for places where they can potentially put some money because of the relatively sort of better positioning. So Japan was singled out as one of the favored destinations for stock bets by a lot of brokers and also investment houses. So we've seen Morgan Stanley singling out Japan to say that they're actually the most bullish on Japan right now. It looks relatively good for the reason that Japan is actually quite eager to get a trade deal done. And it's very likely that Japan's going to get a priority for all these deal negotiations with Trump. And then second, a reason for Japan is that Japan's stock market has mostly priced in any recessionary risks. And the third reason for Morgan Stanley to favor Japan is the broad sort of weakness in the yen. I know yen has really strengthened, but I think compared with a year ago, it's still quite a lot weaker. So all these things are actually playing in Japan's favor now that China's really having a full-blown trade war with the US. And for Japan, there is another thing to look out for, which is earnings. And we saw a couple that have already released results, including fast retailing, which was a bit surprising in a way that they said tariffs only had 2 to 3% impact on their profit in the second half. So it's, we'll have to see whether it's a standout or it's, just signaling a broad trend for Japan's consumer companies.
What about the outlook for Korea? We saw the Kospi falling into bear market territory this week, and we know that economy and some of these heavyweights trading there are so export reliant.
Yeah, I mean, Korea, there's similar dynamics playing out for Korea in the sense that Korea is also very eager to get a deal done with Trump. Trump did tout earlier this week that he had a really good call with the acting president, Han. For Korea, there are a few other things at play. Of course, there is election that's coming potentially in 60 days or so. So some of the investment houses have told us that they are adopting a bit of a wait-and-see stance when it comes to Korean equities. And of course, another element to mention about Korea is really the value up, dynamic, whether the government is really going to push that through. So far, based on our reporting, it seems to have bipartisan support. So some of the houses are already positioning for the Commercial Act to eventually pass, maybe by the new government. So there's a lot of sort of optimism about those really deeply discounted companies in Korea, including a lot of the holdcos of those chaebols.
Bloomberg's Yan Ting-tu there with what to expect as the market opens in Japan and South Korea in less than 10 minutes. Berkshire Hathaway may price a 7-part yen bond offering on Friday, even as sharp market volatility prompts several Japanese companies to cancel sales. Bloomberg's Asia credit editor Finbar Flynn joins us now in Tokyo with the latest. So, Finbar, how is Berkshire really navigating this sale in a week of historic volatility?
Good morning. Yes, Berkshire has really surprised people in that it hasn't given up on this deal. It's pushed ahead with the deal while many have, taken to the sides. And there's been a level of an appreciation for the issuer. It's obviously a large US issuer led by Warren Buffett. And they've continued to do this every single day for the last week, and the spreads on the deal have gone to the wide side. But investors believe here that it offers good value. It's one of the highest rated names in the financial world, and they're just glad to pick up the additional spreads that are being offered because of the volatility.
Finbar, what are we hearing from investors?
So investors actually, we've seen these moves in the JGB market, and they're not of the same magnitude, we'll say, in the Treasury market, but we're seeing 10 basis point moves almost daily. So investors are saying, well, Berkshire doesn't issue that much in all these different currencies. So they're willing to take the risk with Berkshire because not only are Japanese investors interested in the name, but also overseas investors are interested in the name. And that's giving them added comfort around getting into Berkshire, this deal.
And what would this sale actually mean for the firm's investments already in place in the country?
That is indeed one of the biggest focuses. Berkshire has said already this year that it owns 9%, a little over 9% in 5 of the largest trading companies, including Mitsui, Mitsubishi, Itochu, and it's indicated that it might want to increase that share. So people are always on the lookout for how much it raises in these deals, because it's expected that it will use some of those funds to actually increase its equity shareholdings in the country.
Bloomberg's Asia credit editor Finbar Flynn there with us. We will be watching out for that yen bond sale very soon. We have more ahead on the Asia trade. This is Bloomberg.
Latest from the corporate front, and shares of Capri Holdings fell sharply in New York after its Versace brand was acquired by rival Prada for nearly $1.4 billion in cash. The move returns Versace to Italian ownership and could put the company in a better position to compete with bigger luxury rivals such as LVMH and Kering. The deal is the largest in Prada's history and should close in the second half of the year. Shares of US Steel tumbled after President Trump's latest flurry of comments opposing a takeover by Nippon Steel. The stock whipsawed as Trump suggested Nippon could be an investor without explaining how that would work. Trump also questioned why Nippon Steel couldn't build a new plant on its own.
Look, US Steel is going to do very well now because of tariffs, and I don't know why they even need a deal, but the only thing is US Steel, if you go back 80 or 90 years, that was a behemoth in this. That was our biggest, most, if we were around, we would have been very proud of it. Today we have different types of companies that are big.
Take a look at how futures are setting up for the market opens in Japan and South Korea very soon. The Nikkei now dropping and pointing to downside of more than 4%. U.S. futures also declining 0.6%. We are headed towards the South Korea Open as well. We're hearing from the Finance Minister Choi Sang-mok in a meeting with financial authorities saying that uncertainty is still high despite the 90-day tariff pause. Of course, we already heard from Prime Minister Ishiba saying that they are launching a task force on those U.S. so-called reciprocal tariffs. The Japanese yen holding at the strongest level since October versus the dollar. The market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens and another violent reversal on Wall Street. The White House clarifying that the tariff on China is actually rising to 145%. So, Haidi, we've even heard from President Trump acknowledging potential transition problems.
You know, and this is why we had so much sort of words of caution, either from our own internal analysts on these markets or external analysts saying, look, there was perhaps more, style than substance when it comes to this 90-day pause. We've still got the now 145% tariffs when it comes to China. We're now also seeing some of these signs of, non-trade weapons being wielded as well, right? Be it Hollywood film approvals or potentially, as we keep looking at, yuan devaluation and some of the other things that might be on the table as well.
No wonder we had such volatility in the overnight session. U.S. stocks actually more volatile right now than Bitcoin. Take a look at the Nikkei coming online, down almost 2% together with the topics. And this after the Nikkei already saw the best day since August. The Japanese yen continuing to gain ground towards that 143 level against the U.S. dollar. We're talking about the strongest levels since October. Prime Minister Ishiba already talking about launching a task force on reciprocal tariffs. We are also awaiting Berkshire Hathaway's yen bond deal. This coming, of course, at a time of heightened volatility. Do keep an eye on those 10-year JGB yields. Of course, they jumped in the previous session. A lot of volatility. Take a look at how South Korea is coming online as well. We are now getting the latest lines from South Korea as well when it comes to the export numbers for the first 10 days of this month, rising 13.7% year on year. Of course, we keep a very close eye on this economy, given that it's a bellwether when it comes to global trade, and we're seeing the Kospi now losing more than 1.5%. This after we saw the Kospi rallying the most in 5 years. We also heard from the Finance Minister Choi Sang-mok that uncertainty is still high for the South Korean financial markets, despite the fact that, of course, we saw that 90-day tariff pause coming from the United States. Haidi.
And all of this whipsaw sort of policy decisions and reversals and really upending these expectations for global central banks, right? And as you see that dollar weakness play out, clearly there's expectations that the Fed will have to come to the rescue of the U.S. economy. The verdict is still very much out when it comes to expectations from the rest of the world's central banks, right? Take a look at what we're seeing in Australia. Some downside that are about 0.5% just at the start of the staggered session. Some of that will be to do with some disappointment from the RBA. We heard from Governor Michelle Bullock really urging caution Washington saying that the last thing they want to do is to add more uncertainty into this global mix, and that they really need to kind of be more data dependent to see how quickly they need to move. Expectations have been building for 50 basis points in May. That's now been pulled back closer to 25 basis points by some analysts. This is what we're watching when it comes to Australian bonds as well. We are seeing the short end notes lagging behind US peers. That's the expectation after what we heard from the RBA. But certainly that volatility across both the short end and the long end continues across sovereign bonds. Shery.
Right, Heidi, our next guest says she's positioning for more international stock exposure versus the U.S. for the rest of the year. Let's discuss this with Dayeon Hong, multi-asset portfolio manager at Shinhan Asset Management. Great to have you back, especially in our new Seoul studio. So let's talk a little bit about this incredible volatility that we're seeing this week. What is your rationale right now in positioning more into international markets when, of course, as the U.S. moves and swings, we could also see especially more developing economies suffer?
I like to be in markets where I can see a bit of a certainty in terms of policy push. For example, in Germany, we know for sure that fiscal spending is coming. Whereas in the US, we're not sure when the Fed will cut just yet. We've seen a slightly constructive number of CPI last night, but still we don't know how much of the tariff will impact the inflation. And so we're very limited in terms of monetary easing in the US, whereas we're seeing ECB probably be cutting next week. And also in China, we're seeing a lot of stimulus coming in. So we'd like to be positioned in Europe and parts of Asia compared to US, at least tactically.
When it comes to the US, though, do you expect a little bit of a rebound if we do see some more measures coming from the Trump administration on taxes? We know that the US House just passed sort of a budget outline that would lead to more than $5 trillion over the next decade in tax cuts, debt ceilings also being raised.
Yeah, so no one is really talking about the good news out of this administration. Everyone is talking about tariffs. But tax cuts are coming. We also know that deregulation is coming. And so beyond the tariff horizon, I think there could be good news. That's why we are hesitant to be significantly underweight equities in general. We typically follow benchmark, and if you're underweight in days like Wednesday, for example, you just lose a huge amount. So we want to be close to the benchmark, but closely follow where the policy is moving. We don't know where the tariffs will end, but the news headlines could quickly change to tax cuts and deregulation, as we also expect some of the bank earnings coming out starting tonight. The banks could start talking about deregulation.
But as a portfolio manager, how tricky is it at a time that also it seems a lot of the safe havens are not necessarily acting like havens as well?
Yeah, we are certainly in an environment where heightened volatility and heightened uncertainty. And so I can understand some investors, there's a need to move away even from US Treasuries. And that's why we're seeing a huge spike in yields that we've seen in the past week. But I would take this time as an opportunity to buy US Treasuries and even lengthen duration. If you think about it, we started the year of 10-year US Treasuries at 4.6%. Now, we're not too far away from that level right now. And for most investors, growth forecasts compared to the beginning of the year probably have come down. And so it does not make so much sense to me to have 10-year yields at this kind of level if you kind of think about the downside risks to growth in the US.
It's interesting because we are just seeing a lot of speculation when it comes to what's going on with treasuries, right? It's interesting that we're seeing that SMBC Nikko, there's one strategist, so senior interest rate strategist, saying that China may be selling treasuries in retaliation for the higher tariffs. Of course, the question is, why would they kind of do that under the radar when they could potentially get a lot bigger response if we knew about it? But does that level of sort of, potential risk play into what you're thinking when it comes to adding to Treasury's positioning?
Yeah, it definitely is a risk, and some investors are suspecting that because we've seen intraday high at 4.5% on Wednesday during Asian trading hours, that some Chinese and Japanese investors are selling. But to me, US dollar is still a reserve currency. We could see some volatility, but beyond that, the dollar will probably have that standard as a safe haven status. And so we'd like to take, this hike in yields as an opportunity to slowly build that portfolio. I wouldn't go immediately put a huge position into it, but as we see that volatility, take time to lengthen the duration.
When it comes to opportunities in Asia, obviously there's been some markets that have been really targeted by these tariffs, including the likes of Vietnam, for example. At the same time, the likes of Vietnam, Japan, potentially South Korea are also in the midst of kicking off negotiations with President Trump's administration. Are there opportunities that you see if we see that recovery?
Yes, I prefer to be in bonds than equities during this time in Asia. We are positioned for overweight in Korean bonds versus equities currently. Now we have risks in terms of supplementary budget, for example, when countries announce a huge fiscal spending, we could see some upside in yields then. But I think structurally, if you think about towards the end of the year, we're likely to see slowdown in growth. So it makes sense for me to be in bonds rather than in equities.
Dayeon Hong, really good to have you with us, multi-asset portfolio manager at Shinhan Asset Management. As we continue to follow this sell-off across Asia at the moment, we are seeing every sector in the red when it comes to the topics. Also, the Nikkei losing ground by the most since just earlier this week, given, of course, that we've seen already a massive sell-off, then a rebound. Right now is another session of losses with the Japanese yen also headed towards that 143 level against the US dollar. The Kospi also down. You can see that a sea of red at the moment. This is Bloomberg.
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond nobody. How people stood for it, sitting in my position, is not even believable.
President Trump speaking there after the White House confirmed that US tariffs on China have risen to 145%. For more, let's bring in our Bloomberg News Desk editor, Jill Desis, and our China correspondent, Min Lo. Jill, I'll start off with you. And, you can see that whipsaw reaction in markets, right, despite that 90-day pause, the sort of reality hitting that, with this major trading partner with two of these countries that hold so much global heft when it comes to trade and the global economy, things are just getting worse.
Yes, Heidi, I mean, it is reality hitting, right? Look, it's not even just about this element of the China issue here. I mean, I'm not sure that markets, flipped just because, suddenly it's a 145% tariff rather than 125% tariff. I think the other part of the reality that we're really looking at right now, Heidi, is that this is just a pause on these tariffs for 90 days. Once we get into July, I mean, we really have to consider what it actually means once again for pretty much every nation on the planet to make a deal with President Trump right now. I mean, remember, part of the frustration for a lot of these governments in the first place was that these, so-called reciprocal tariffs weren't really based on reciprocal tariff rates that these countries have set on the United States, right? A lot of this just comes down to Trump being incredibly dissatisfied with trade deficits. And so those tariff rates that, were briefly in effect and then ultimately paused were based on trade deficits. And so, I think that, a lot of these countries, it's still kind of unrealistic to say, how do we eliminate a trade deficit with the United States? Like, how do we ultimately make Trump happier? I think, in the end, there's just a lot of uncertainty that's going to happen over the next 90 days, possibly longer. We're still just not clear on what it actually takes to make a deal.
Well, at least when it comes to Beijing, they don't seem to be too preoccupied in making President Trump happier. Min, what are we seeing from China so far?
Yeah, so actually the Chinese Commerce Ministry responded yesterday saying that they are ready to have dialogue on an equal basis. But if not, then they are still going to fight to the end. And we heard that soundbite from President Trump earlier saying he would love to have a deal with China, but he has previously said he's waiting for that call from China. So both sides waiting for the other party to extend the olive branch to create that opening for scaling down tariffs. And I'm not sure just when that is going to happen. But for now, though, China has retaliated by saying that they would moderately reduce the number of imports of U.S. films this year. And it's an interesting move. It's a move that is high profile, yet comes at very little downside to China. It would cost some of these Hollywood films maybe about a fifth of their global revenue, which comes from China. And some analysts are saying, because the wording here from the Commerce Ministry, it's not an outright ban on the film, it's moderately reducing the number of films. They're saying that maybe China would still import the big blockbuster films because that could still at least inject a little bit of consumption boost in China, something that they desperately need right now, given that the box office is still a very important anchor for the overall retail sector.
And Jill, of course, we continue to await any conversations or any results from the conversations that President Trump could be having with its trading partners. Kevin Hassett saying that the talks are in an advanced stage. What do you think is happening right now behind the scenes?
I mean, certainly, the Trump administration is working with some of these countries. And I mean, we know that because we've heard from, places like Japan, places like Korea, Vietnam, that they're sending trade negotiators, that they've opened talks, they've started dialogues with the United States. Once again, though, it's unclear how far along those talks actually are. One would think, and again, this is a little bit of supposition, but one would think that some of the United States' closest allies maybe have a little bit of an advantage there in terms of trying to negotiate something. You would think that maybe a nation like South Korea or Japan might actually, be able to make some inroads. But again, I mean, when you look at the types of tariffs that places like the European Union and Canada, were facing earlier this year, some of the things that they're still tripped up there. It becomes really, really unpredictable in terms of what the Trump administration ultimately will reach here. I mean, this has gotten to the point where you've got a lot of corporations around the world that are, really unsettled by what's happening here. Saying that this is actually the highest level of unpredictability since the COVID pandemic in terms of, what they do when they're setting their, full year guidance, how exactly they're looking at operating profits over each quarter. I mean, again, I think all of this just really underlines that while, you've got a lot of these nations, maybe accepting China that are coming to the table and saying, they'd like to negotiate something here, we just don't really have a whole lot of clarity on what a successful trade negotiation right now looks like.
And we're hearing that President Xi is set to host top EU leaders in a couple of months. And we're really kind of seeing this dual strategy play out, right? Both trying to beef up the domestic economy and domestic consumption, but also this outreach and charm offensive for other trading partners.
Yes, definitely. Already this week, there had been a couple of calls, Premier Li Qiang speaking with Ursula von der Leyen, and then the trade representatives from both sides having a video call as well. And an interesting readout from the Commerce Ministry saying that both sides had agreed to immediately begin negotiations on possible price commitments on electric vehicles. And this is an interesting development. Could it be a hint of potential lowering of tariffs from the EU to come, especially given the SAMP report that China could be hosting these European leaders in July? And of course, don't forget, there is the Spanish Prime Minister Sanchez visiting Beijing this week as well. Today, in fact, really going against the U.S. warning from Scott Bessent, saying that a tilt to China from the EU is essentially equivalent to a cutting their own throat. But the Spanish Prime Minister is saying that not only are they wanting to negotiate with the U.S., they are still going to not just carry on trade with China, but increase trade as well. So you see this sort of intensifying outreach from China to the EU, to Southeast Asia as well, because President Xi is making that trip to Malaysia, Cambodia, and Vietnam next week, certainly and upping the ante on trying to intensify trade ties with other countries in the region.
Bloomberg's Mimi Lowe and Jill Deasy is there with a breakdown, of course, on all of the tariff news, especially around China. The U.S. now imposing 145% tariffs. Now, Bloomberg Originals has been taking a closer look at what President Trump is really trying to achieve here as his trade war stokes market chaos as well. Take a look.
On April 2nd, President Donald Trump made good on a promise.
Starting tomorrow, the United States will implement reciprocal tariffs on other nations.
That oversized printout represented a seismic protectionist shift in U.S. policy.
Very quickly after the announcements, we started seeing other world leaders talking about potentially negotiating or retaliating.
It's definitely the biggest shock to the global trading system that we've seen since World War II.
Trump's tariff wrecking ball careens through the markets.
Not Liberation Day, but Obliteration Day.
Whose throat do I get to choke if this proves to be wrong?
There's only a few events that rank up there with the kind of losses that we've seen in U.S. financial markets in particular.
Major global indices nosedived, including the S&P 500, the FTSE 100, the Nikkei 225, and Germany's DAX. Over a handful of days, business leaders and investors piled pressure onto the administration amid plummeting markets and palpable fears of a global recession. Then, just hours after the highest tariffs went into effect on April 9th,
President Trump announces a 90-day pause on reciprocal tariffs for all countries except China.
Most countries would only be taxed 10%, but the tariff was going even higher on China, the world's second biggest economy. So what now? How is all this meant to work in the long term? And what could happen when a new 90-day clock stops ticking?
Subscribers can see that report in full right now on the terminal or Bloomberg.com. It also will be available later on the Bloomberg Originals YouTube channel. Much more ahead here on the Asia Trade. This is Bloomberg.
I'm not the politician, I'm not the negotiator, I'm not the person to say whether that style of handling it was better or worse. I would say that it dramatically affected psychology and attitude about the United States' reliability.
Bridgewater Associates founder Ray Dalio, as we continue to watch Haidi, how Wall Street is really talking about this tariff uncertainty unleashed by President Trump. We're trying to not only understand the different levels of tariffs and all of these measures, but also perhaps seeing a little bit of self-censorship as well. It's been really interesting trying to gauge Wall Street's fear of really criticizing President Trump directly. And one example, which was really interesting, a JP Morgan analyst redacted report. Michael Sembalist really releasing this report with, as you can see, clearly redacted lines, telling his clients that he actually withheld some material because he was thinking about his firm, about his company, about his colleagues as well. So this sort of self-censorship reverberating across markets. We have, of course, seen the administration targeting large law firms, universities, media outlets as well, really upending these traditional norms around how the U.S. government behaves in relation to institutions, right? I mean, after calling the president's plan a sledgehammer, also brute force, you can see the rest, and a big chunk of that report was actually redacted.
Yeah, and you have seen that sort of balancing act in terms of the criticism and the concern being expressed by the likes of Jamie Dimon, by the likes of Bill Ackman, who we know was one of President Trump's biggest supporters during the campaign, that, you know, this sort of idea that they agree with the direction in terms of the underlying reasons for why this trade strategy is taking place, but obviously wanting that reprieve. We saw just hours after what was a pretty full defense from the Treasury Secretary, Scott Bessent, we saw the president then embracing one of the ideas put forward by Bill Ackman, which is that 90-day levy pause, rather than risking what he called a self-induced economic nuclear winter. So that proposal had been floating around as a symbol of kind of, influence on Wall Street, and it was taken up this week, which I thought was really quite interesting as well. So we also saw recession calls from the likes of Jamie Dimon, who was on TV, and that was apparently watched by the president. We had strong words from the likes of Ken Griffin, Stan Druckenmiller as well. So it's very interesting to see how all of this played out, and certainly how that played out with the rally after President Trump said it was a great time to buy. Right, perhaps not at the moment today, although, if you sort of wanting to exercise that risk appetite and getting some, cheaper valuations today, the sell-off might be just how to do it. But take a look at how European futures are opening, Shery, as we see that sell-off prevail across the early part of the Asia session. Euro Stoxx 50 futures are off by about 0.6% there. We see weakness when it comes to German DAX futures. This after European equities jumped the most in 3 years in that session that followed the tariff reprieve, and even as we had, a little bit of reprieve when it comes to the metals tariffs as well, we're not going to see that necessarily play out when it comes to risk sentiment. We did see that sort of expression of relief, but still that caution that the trade war is by no means over. Uncertainty, risk premiums clearly still persisting there, and a really split market in terms of who plan to increase exposure more and others that are holding back. More ahead on the Asia trade. This is Bloomberg.
Tariff is like a negative supply shock. That's a stagflationary shock, which is to say it makes both sides of the Fed's dual mandate worse at the same time.
Chicago Fed President Austin Goolsbee there warning, of the potential stagflationary effects of the Trump tariffs. This is, of course, the anticipation and expectation for that Fed sort of intervention when it comes to the trajectory of their policy continues to play out when it comes to U.S. assets. You can see that when it comes to everything from the dollar to yields, right? We did see a little bit of sort of abating of the worst fears of the mayhem that we saw in Treasuries, a U.S. 30-year bond auction kind of helping that in terms of the fears of a buyer's strike. So that solid auction result was one good side when it comes to seeing still plenty of Treasury buyers, but there has been just a week of intense volatility that we've seen, and at the moment we're seeing that yield curve just steepening. We're seeing some steepening when it comes to Australian sovereign bonds and the yield curve there as well.
Yeah, we're seeing stronger Japanese yen also today towards that 143 level against the U.S. dollar. We're seeing the Japanese stock market also really under pressure, with the Nikkei reversing that best day that it saw since August. The Kospi also down almost 2% as we continue, of course, to hear the latest on the tariffs. Prime Minister Ishiba wanting to launch a task force on these so-called reciprocal tariffs. And South Korea also talking about the uncertainty still being high despite the 90-day tariff pause coming from the Trump administration. Let's get more perspective on the businesses that are navigating tariff policy challenges, especially for export-heavy countries like South Korea. Joining us now is James Kim, Chairman and CEO at AmCham Korea. James, really good to see you again.
Thank you. Great to see you, and congratulations on a beautiful opening of your studio.
Thank you so much for acknowledging our new Seoul studio, which really comes at a perfect time when we're just trying to really wade through all of the news, especially when it comes to South Korea. I mean, what do your members make of everything that's happening in the tariff environment?
Well, obviously, we're all very concerned about the high tariffs that Korea, encountered. It's really because we feel that Korean companies have invested tremendously in the United States, became the #1 largest FDI in the U.S., $140 billion worth of commitments by Korean companies the past 2 years, and many of them in the traditional Republican states like Texas, Indiana, Georgia, Alabama. So we were a little surprised.
Yeah, they weren't spared, right? But at least is there some sense of optimism that President Trump is talking about flexibility when it comes to these tariffs?
And we feel that because President Trump is a business person, he understands the value that Korean companies have placed in the United States. I still remember under Trump 1.0, he talked about Korean companies investing a lot in the U.S. And now under Trump 2.0, I feel very confident that Korean companies are going to continue to do that and make President Trump very happy.
It seems right now that we're still trying to understand what President Trump ultimately wants to achieve, right? Some people are talking potentially about just a change and a reorganization of the global world order that, of course, was ruled by the WTO. The organization has been sidelined. And in a way, because of what's been perceived as unfair practices by China. And perhaps other trading partners as well, when you're seeing non-tariff barriers that are still high. Sure. When it comes to businesses, do they understand that? Do they think perhaps we can bear with the short-term pain as long as we have long-term gain?
You know, I think education is very important. A couple of weeks ago, I was very fortunate to host Governor from Alaska, Mike Dunleavy. He came to Korea on an LNG visit, and he educated the public a lot about why President Trump is doing this. $36 trillion worth of debt they went to service. The middle class, the lower class, losing out on job opportunities. So he feels that because of some of the things that he's doing today, it's a new start for America. And I think that as long as we can execute it properly, maybe a little bit more surgically, this is a great opportunity for Americans and for the U.S.
How much buffer do businesses have to be able to take that short-term pain?
I do believe that most businesses look at businesses in a long-term basis. As a stock market investor, you should always look at long-term. And I believe that America is going to be a great place to invest continually, no different than Korea is today. So you may have some short-term blips, but I do believe that over the long term.
What do you expect to be the low-hanging fruit in these negotiations?
Well, I think that the low-hanging fruit is what countries and companies have done well for the U.S. And I look at a company like Hyundai. They were the first to really announce a big investment both in Louisiana and also in Georgia. And I think that makes Hyundai look really, really positive. And I do know other Korean companies are lining up to invest in America. And that's some of the things that we do at AmCham to help Korean companies really have a better understanding of the U.S. and some specific pockets of opportunities.
When we have seen this supply chain reorganization because of the U.S.-China conflict already from President Trump's first term, and perhaps the rivalry just continuing to grow, we saw some of these companies really trying to diversify through Southeast Asia, but then you have the likes of Vietnam getting these huge levels of tariffs. How will businesses think about supply chains in the future?
You know, I've talked to a lot of different CEOs of companies operating here in Korea that are faced with these tariff concerns. I think what they're doing is in the short term, it's going to be share the pain kind of a scenario. Maybe a third would come from their supply chain. A third would come from them directly. Maybe a third directly at some small pricing increase to their customer or the consumer. And I think over the short term, people can kind of understand what the pain is and kind of grow with it. And over the long term, be better positioned to win for the long term.
There are some businesses that will have margins that can't even cope with that level of pain sharing, right? Is that the biggest risk?
Obviously, some companies are in a much better position to handle the margin pressures versus others. I think that through strong partnerships that stronger players will have with some of these smaller players, I think they will continue to survive and be positioned better.
James Kim, really good to have you with us. We'll have to leave the conversation here, but he's chairman and CEO of AmCham Korea, and it's always a pleasure to speak to you when we're hearing in Seoul. Heidi, as we speak, we're hearing now from the trade negotiator of Japan saying that Scott Bessent can be a tough negotiator. Of course, we are expecting those negotiations and the results to come first from Japan and the United States.
Yeah, amidst reports that there are somewhat 15 separate negotiations and deals that are on the table. So watching to see if any of those come to fruition. But take a look at what we're seeing in FX, Shery, because some pretty big moves given that backdrop of dollar weakness there. The euro surging as much as 1.6% amid that broader dollar weakness story and just the incredible bearishness that we see against the greenback in these markets. Again, extending gains to 1% against the dollar. And we're also seeing the extension of that rally when it comes to the Swiss franc as well, to gain 1% against the dollar, so hitting a decade high. We are seeing that risk of sort of haven bid really play out when it comes to not just currencies, but we're seeing that reinforcement of buying when it comes to gold as well. The euro at the moment soaring to a 3-year high there, with the Bloomberg dollar index falling another 0.6% in a fourth day of declines. We should also talk about the yuan there as well, ahead of course, the PBOC fixing. We are hearing from Danske Bank saying that they only see a moderate weakening of the Chinese currency, a possible 5% decline over 6 months, and that shock yuan devaluation calls are perhaps overblown. This, as we did see that rise in the yuan amidst the dollar weakness. But of course, the currency issue is really one that has quite a bit of vulnerability around it at the moment, in terms of one of the ways in which we could see Beijing respond a little bit more strongly.
Yes.
Yeah, it would be awesome.
Spanish Prime Minister Pedro Sanchez is in Beijing today discussing trade and economic cooperation. He is the first European leader to visit China since President Trump slapped tariffs on most of the world. Our Bloomberg reporter Daniel Bastero joins us now on the line from Beijing. And Daniel, we're also hearing that potentially President Xi will be hosting top EU leaders in July as well. So this sort of diplomatic charm offensive to reach out and fortify relationships with other trading partners outside of the EU is very much on foot. It's a pretty critical visit for both sides. What are the deliverables that we're watching?
Hi, Heidi, Shery. Indeed, this is a trip that has been prepared for months and focused mainly on trade, because Spain has a considerable trade deficit with China and Vietnam, where the president was yesterday and the day before. But, of course, the moment is key, and Prime Minister Sanchez will be the first European leader visiting Beijing and meeting President Xi Jinping. So the visit itself is the message. And the European Union, as you know, is at a complicated moment. It's the main U.S. trade partner, but in light of tariffs, the EU bloc is trying to diversify. So this trip is important because it's the first EU leader to visit Beijing, and we expect Spain to bring to Beijing this policy of getting closer to China now that President Trump is taking far away the U.S. or Europe.
Can the EU position towards China sort of change amid the trade war, depending on how the negotiations go?
Well, that's hard to say. All the countries, and certainly the European Commission, have a harder line than Spain. The European Union sees China as a partner, as a competitor, and as a rival. And there are differences among countries on where to intensify the accent, right? Consider China more as a partner or more as a competitor. The European Union have differences with China regarding non-tariff barriers or regarding imports like the electronic vehicles. So it's hard to say at this point, but Spain is certainly pushing for getting closer to China, and as you say, there are high-level meetings between Chinese officials and European leaders. The presence of President Xi Jinping in these meetings is still to be seen, but there is certainly something going on, and voices in the European Union calling for getting closer to China.
We've seen Scott Bessent warning against the EU getting closer to China. In fact, he said it would be like cutting your own throat. You can't blame the EU, given, of course, its current deteriorating relationship with the US, right? Could we see retaliation, though?
That's to be expected. Actually, those comments came from Secretary of Defense during Sanchez's trip to Asia, and he said precisely that getting closer to China would be cutting your own throats. What Spain is replying to the United States on that regard is that the European Union is united and is just defending their interests. From a Spanish high official here in the street, we heard that the United States cannot expect, after imposing tariffs, even if there is a 90-day pause, the United States cannot expect the European Union to just sit and applaud. The European Union wants to diversify trade relationships, and that includes Asia and China in particular.
Bloomberg's Daniel Bastero there. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to US traded Chinese assets. And of course, we've been looking at this potential form of retaliation that we see spreading to non-tariff measures now, given that we're seeing tariffs at 145%. It's quite hard to see where they can go from there. But we're starting to see that speculation when it comes to delisting Chinese listed US assets as being one potential weapon that reversed an earlier gain in the session amidst this increased speculation that the ongoing economic war with China will take place on this front now. We saw the Golden Dragon Index sliding to a new session low, but not quite as bad as sort of earlier in the day. Scott Bessent had been telling Fox Business that everything was on the table when he was asked about whether Chinese companies could be kicked off US exchanges. Well, as China's tech stocks respond to increased market volatility, some investors and analysts are also watching concerns that may have a bigger impact than President Trump's tariffs. For more, let's bring our Asia equities reporter Charlotte Yang. So, Charlotte, what are these sort of bigger concerns? Because there is the implication of what happens if some of these companies are truly going to face a US delisting.
Yeah, so investors and analysts, a lot of them we talk to, they're now mapping out different scenarios if like the risk, the tensions between China-U.S. relationship further escalate. And so far, the market has been talking a lot about tariffs. And for tariffs, they do have like a, direct impact for some of those China's e-commerce platform shares. But outside of that, for the bigger China tech cohort, it's more the secondary impact from tariff that might, weigh on, for example, China's macroeconomy or that. But investors feel like that has been pretty much, a lot of it has been already priced in. So now they're more focused on what happens if, for example, the U.S. go on to with some non-tariff measures. We have seen sort of the playbook in the past where they are, for example, talks about delisting or access to tech equipment and all of that. And that's a serious, that as one fund manager was saying, that's more of a serious risk or even like a black swan event that they're now thinking and worrying about.
And we really haven't put that much attention to the fact that the U.S. will actually be taxing the imports of shipments priced up to $800 at the rate of 120% of their value just starting next month. How significant is this for these e-commerce companies that depend a lot on just shipping to the U.S.?
Yeah, so I think among the Chinese e-commerce platforms, PDD is the most vulnerable because of its Temu exposure. And we do have Goldman Sachs research that shows how, they're worried about the U.S. orders volume taking a direct impact and also the logistics pressure it could come and how that could weigh on the U.S. consumer sentiment. And Alibaba shares also, while, the sales, direct sales exposure from U.S. is much smaller, but their shares nonetheless, have fell over the past weeks due to those kind of concerns. And but also, what I think it was also matters for the cohort is that given the valuations has really a lot, and investors remain very positive about the AI development. And if we do see Beijing coming out with some sort of policy put or more stimulus to support the economy, there is also expectation that these cohort could re-rate very fast from the current valuations level. So a lot of like changing variables on the table right now. I guess it all depends on what happens happens next with both what Beijing do and what Washington do.
Bloomberg's Asia Equities reporter Charlotte Yang there. As we're now seeing breaking news out of Japan, we are getting Berkshire Hathaway now raising 90 billion yen from a bond sale. That's around $628 million. This is the smallest Berkshire yen bond deal smallest ever. And this really to do with the fact that we have seen, of course, and we continue to see the immense market volatility. Actually, several Japanese companies had to cancel sales, but Buffett's company was selling the yen bonds despite these global trade tensions, sparking market volatility, funding costs rising across the board, of course. But this offering is also going to put under the spotlight the fact that these funds raised could perhaps be used to increase Berkshire stakes in some of those Japanese firms that it already holds. That's been a big question. So now we're getting the latest line that it's raised 90 billion yen from that very much awaited bond sale. Chinese state media are hinting at a possible rate cut on the horizon. That comes as Beijing lets the yuan weaken against almost all major currencies to support its economy, amid, of course, a trade war with the U.S. The China Show co-anchor David English joins us now from Hong Kong. David, what a week. Happy Friday, thank goodness.
Yeah, we're here, but we're not done just yet. And I think it's good how you frame that, Shery. You know, a rate cut is certainly on the horizon now in China. I mean, you look at the indications of market, you look at what state media, front page commentary on Thursday out of the Securities Times indicating that we could see one as well. And I think it's worth pointing out, just to take a big step back, that the markets were effectively told going into the new year that, you know, a triple R cut was coming out of the PBOC. And then, of course, between late December and I would say 2 weeks ago, the priority of policymakers became currency stability. And the last few days have basically showed a turning of the page from that priority, from currency stability to growth. I mean, we're looking at 6 straight days, possibly a 7th day of a weaker fix today, which effectively opens up more weakness in the Chinese currency. We're showing you a chart of swaps right now have now turned back below your 7-day reverse repo rate. And apart from that, really, so possible windows for this, and again, it's very hard to time this, but possible windows could be, we've seen monetary policy action be announced late Friday, sometimes even in the weekend, so we're obviously looking ahead to that as well. There's a daily open market operation that is also a possibility there. Plus, of course, looking at next week where we have the loan prime rates and an MLF operation as also possible windows of opportunity to lower rates in China. We have a bond auction today, by the way, just to mention that as well. So we'll get an indication from markets right now what the appetite will be for current paper, given those expectations of cuts perhaps moving forward, Heidi.
Our China Show anchor David English just hoping for all the journalists that we don't get a return to that Friday night PBOC rate cut special, right? We're ahead on the Asia trade. This is Bloomberg.
If we're doing tit-for-tat on tariffs, then China loses because there is no functional equivalency in the amount of goods and services moving back and forth. So we'll see what happens here. But I think it looks like we're in a game of we can call it a Chinese standoff or we can call it a Mexican standoff. I don't see an off ramp here.
AmCham Capital founder and CIO Carl Bass there speaking, and take a look at how we're looking forward when it comes to US futures trading. It is obviously a risk-off session that we're seeing across Asia at the moment as that sell-off resumes with these 145% tariffs on China and really kind of the reality check that a 90-day reprieve, and despite a number of trade talks and negotiations, according to the White House, are on foot at the moment, there is just a complete absence of certainty on what to expect policy too. We are seeing that downside across most Asian markets, in fact, most if not all sectors at the moment as well. S&P futures looking like we're seeing a big dip there. TAIEX futures down 1.6%. Of course, this has been one of the hardest hit in terms of some of the tech-heavy weights across Asia, as well as that's the last trade when it comes to A50 China future. And of course, that delisting risk will continue to plague some of those tech giants in China, Shery.
Yeah, and tech really one of those big losers in today's session. The Nikkei down more than 5%. We continue to hear from Japanese officials around these tariff reaction. Chief Cabinet Secretary Yoshimasa Hayashi saying that he will discuss tariffs with the U.S. at an appropriate time, at a time when we're also hearing from the top trade representative Yosei Akasawa talking about how he's discussing the tariff and the negotiations with Scott Bessent. This is Bloomberg.